45 million Americans who are either classified as credit unscorable or credit invisible.
Hi, everyone. My name is Corliss Hill, and I am the Senior Director of Inclusion and Belonging at Experian North America. I'm really excited for today's conversation because I'm here with Dr. Vaneesha Dutra, and she is the Endowed Professor of Finance and also the Associate Dean at Morehouse College. And she brings a plethora of information in terms of finance as well as financial well being. So we're really excited to speak with her today. We're also going to spend some time talking about financial inclusion and how data is really starting to change the conversation in inclusive finance. So, Dr. Dutra, with that, we'll jump right in. Okay. So, you've been in this space for a while, and financial inclusion is top of mind for you. But tell us, why is it still important today in this environment?
Well, first, thanks for having me, Corliss. It is great to be here to discuss a topic that is very near and dear to my heart and central to the research that I do and the impact it has on various communities. To answer your question, 45 million Americans are either classified as credit unscorable or credit invisible. Credit unscorable means you don't have sufficient data. Credit invisible is very similar and leads to the same outcome, but credit invisible means you just don't have a credit history or credit profile. Financial inclusion is equitable access and availability to banking and credit services for all Americans. And that's independent of race, gender, or income. So at a very basic level, it is equal access. Now, why is that important? Because we know that if I were to go to a bank right now and want to take out a mortgage, I'm going to go to a bank. Home equity is a major pathway to wealth attainment. So without access to spaces such as a bank, then you're not able to participate in that pathway to wealth. Think about going to a bank to take out a small business loan. Again, equity in small businesses, another primary pathway to wealth accumulation here in the US and throughout the world. If you have 20% of your population who cannot access or is not seen by our financial markets, by our banking institutions, then that leaves a lot of economic growth, economic value on the table. And that represents a significant opportunity.
With that, how does alternative data play into that in terms of driving inclusive finance or financial inclusion?
Alternative data becomes really critical if we are going to capture that lost potential, because those 45 million Americans, Corliss, are participating in our markets. They are consuming. They are paying rent. They are paying their utilities. They are paying other obligations on a weekly, on a monthly basis.
So you talked about the stats, right? But let's talk about the opportunities that exist for lenders and financial institutions to do deeper lending. But let's also talk about the hidden risks.
Banks and financial institutions are not in business to fail, right? They're not in business to loan me $100 and then I default. And assessing risk properly is very essential and core to what banks do. Let's start by addressing the risk. Again, I will state 45 million Americans are either ignored or unseen. These are indeed consumers that pay rent on time every month, paying their utilities every month on time, and meeting many other financial obligations and doing so in a timely manner. If banks do not address the changing demographic and the changing mindset of the consumer, they will be behind the ball and be playing catch up, because there are a lot of fintech companies that are catering to how these younger consumers think. I'll just use this example. The way our grandparents felt about opening a checking account, the way our parents felt about that, the way we felt about it. And I'm getting up there in age myself, Corliss. The way we felt about it is very different than the way my kids think about it. they're happy holding their money in a fintech institution, and they don't think about necessarily a big brick and mortar bank. Unless banks begin to understand the psychology of the current consumer and the shifting demographics of the growing population, they will find themselves behind the ball trying to catch up with smaller fintech and more nimble financial organizations. So that's a risk. The risk is that they're behind the ball and they're missing significant income by ignoring 1 in 5, 20% by ignoring 1 in 5 Americans. So that is a significant risk. And the opportunity, this lends itself greatly and very easily to the opportunity. The opportunity is that you actually do move nimble and that you address the growing needs and shifting demographics of our US population. The risk is, as mentioned before, that there are 1 in 5 US consumers, 45 million Americans who are consuming every day. They're paying their rent, they're paying utilities, they're meeting other monthly, weekly financial obligations, and they're being ignored. That represents a risk because if we are falsely denying credit to a population that, by the way, Corliss, is growing in number, because we also know that those who are unbanked, we call them the unbanked, we know that that population by and large tends to be people from underrepresented communities. And what else do we know? We know that that population is growing and forecasted to be the majority of our population, no longer the minority, but the majority of our population in less than 20 years. Think about the long-term effects of denying a significant and growing segment of our population credit that we know is tied to financial well-being and long-term wealth attainment.
So, but with that, with the growing population, then what are the wonderful opportunities?
The wonderful opportunities for banks. I mean, we can just start at a very, we can start at a profit loss. We can look at a basic P&L opportunity. This is an untapped consumer base. And these, as I mentioned before, these are active consumers. They are actively consuming and leveraging financial products, but they're doing so with fintech companies. So this is a missed opportunity for banks who are not nimble and don't recognize the shift in patterns of our population, and two, of patterns in this younger consumer base. They operate a lot differently. The benefit of banks using alternative data is that they capture a very significant and new consumer base. That's 20% of the population, 45 million Americans. The link to a bank's P&L should be quite clear. Now, there are other risks. Whenever we make a shift, there will be some growing pains. However, the benefits of doing so will far outweigh the temporary and tertiary risks. But the benefits to the overall economy and the banking sector are clear. This is lost potential. This is lost revenue, lost consumer base.
Right. So, Dr. Dutra, when a lender is able to have more transparency about consumers and really evaluate their full financial behavior, what changes?
Absolutely, Corliss. What changes is inclusion happens. When you're looking at a more holistic view of one's capacity to pay, I think it is important to enhance models that we use. Let me give you an example. Let's use a hypothetical situation. Let's call her Claudia. Claudia recently lost her job. So maybe for a month or two, she was late on her payments, which of course will hit her. But we also see that she's never been late on her rent, that she was never late on her utilities, that she was never late on any of her alternative, or her cell phone. She was able to maintain her payments. The late car payment, we can explain why that may have happened, and she was able to obtain additional income. And that shows the level of responsibility that banks probably want to understand. And that's the power of leveraging alternative data and making credit decisions. I use the example of how we assess incoming freshmen. It used to be, what's your GPA? What's your SAT? We no longer just leverage those two quantitative scores. We want to look at the student holistically. And we say, well, wait a minute. Jackie has a 4.0 and has a 1200, 1300 SAT. And Christopher has, a 3.5 and a 1000 combined scoring SAT. However, he was also a student athlete, had to train 5 days a week in addition to doing his homework. He was also the president of student council. When you look at the student holistically, we then get a better picture of one's capacity to actually handle college level work. If we were just to look at SAT and GMAT alone, we potentially falsely come to the conclusion that one of those students was much smarter or had a much stronger work ethic than the other. When you look at it holistically, it was not the case. We're saying, what other information can we leverage to get a more holistic view of this individual's capacity to repay this debt? And I think that's the power of looking at credit and one's capacity in a holistic way.
Right. Now, that's a great example. I love that. So, Dr. Dutra, you authored a paper for us. It was called Bridging the Credit Divide. You provided a lot of insight based upon your data. There are several things that came out of the paper. There were great tips and advice that you provided to lenders who are looking to lend deeper and to extend credit to consumers. Can you give us some examples or some of those tips? Share that with some of our listeners today.
I'd first encourage our listeners today to look at the paper, read the paper. There are very deep insights in it that we don't have time to cover today. But if I were to summarize, I'll summarize quickly. 3 primary takeaways. The first would be to modernize your data. Look at consumers holistically. Modernize your existing model. Don't ignore your existing model, but leverage alternative forms of information so that you get a more holistic view of a consumer's capacity to repay her debt. And that will be critical because we know that access to credit is directly correlated and tied to financial outcomes and long-term wealth. So it's absolutely critical. So 1, modernize your models to be more inclusive in assessing one's capacity to pay. Look at it holistically. The second point I'd make is banks should focus on early intervention. One of the clear conclusions from our paper is the longer a borrower is delinquent, the more likely they are to default. We can encourage and come up with practices that intervene and inform consumers early to prevent that debt from becoming delinquent for greater than 3 months. We know that the bank has a significant chance of recouping that initial loan. The key will be early intervention when you notice that a borrower is late. And that will also mean that banks have to incorporate different processes in their model and how they monitor their portfolios, their loan portfolios. And the third, I'd suggest banks build what I call early entry points, particularly in this new age where these younger consumers think about banking in a different way. They're going to alternative outlets. I believe if banks were to market to the younger consumer in a different way, hey, take out a smaller loan, get them used to walking into a bank, filling out an application or online, but get them used to leveraging a bank's products and services earlier in smaller, more measured amounts so that they build up an acumen, so that they build up a tolerance and behavioral practices of paying their debt and being responsible with their credit. So it's early intervention and it's early action with smaller interval credit availability.
That's great because it's putting them in the practice of understanding how to navigate the financial system in the future.
Absolutely.
Yes, love
Absolutely.
that. Well, awesome. This has been wonderful, Dr. Dutra. Thank you so much for sharing your time, great insights, research, and tips for our lenders today on utilizing alternative data.
Corliss, thank you for having me here today. Thank you all so much.